Hi there, I'm Ray. Today, we're diving into the recent Bitcoin volatility and what the big institutions are actually planning behind the scenes. Bitcoin's been dipping below the $66,000 mark lately, and I know many of you are feeling a bit anxious. You might even be losing sleep wondering why the US market looks solid while crypto is struggling. Today, I'll break down exactly what's happening and show you the key data we really need to watch, in plain and simple terms. Alright, today we've got three big things to look at together. First, we'll dive into the latest US GDP and inflation data to see what signals they're actually sending the market. Next, we're digging into the truth behind the tariff ruling involving former President Trump. Could it really flood the market with liquidity? And finally, we'll look at those recent 13F filings to see why the big players on Wall Street didn't stop buying, even when the market was sliding. First, let's take a look at the market. Bitcoin dipped below $66,000, and with Ethereum hitting 2.8 million, we've seen a bit of a correction this Monday morning. Now, what's interesting is that major US players like Google, Amazon, and Apple saw their stock prices stay pretty solid, even after that Supreme Court ruling on tariffs. A lot of people saw that 1.4% US GDP growth and started worrying the economy's in trouble. But for the US, hitting that mid-1% range is actually considered a pretty solid performance. But lately, with the Atlanta Fed pushing forecasts as high as 3 to 5%, it's creating an optical illusion where other numbers look relatively low. Wondering why these numbers are so low? It's mostly due to the government shutdown last quarter. Since the federal government couldn't release funds properly, spending dropped, dragging down the GDP. So, even if the data looks weak, there's no reason to panic or think the market's over. In my view, you've got nothing to worry about. The latest PCE data, that's a key inflation gauge, came in at 2.9% year over year, keeping those inflation worries alive. If you dig into the details, airfares jumped 0.4% from last month. But that's really just a seasonal thing where airlines reset prices every January. While volatile stuff like food and energy can make the headline numbers spike, there's no need to overreact to every little swing. Next, let's talk about the ruling against Trump's tariffs. The market is buzzing because if they're overturned, we're looking at a massive $170 billion flooding back into the economy. Now, I'll be honest with you. Getting that money back into our pockets is going to be a real uphill battle. Even though the Supreme Court ruled the tax invalid, they didn't actually order any retroactive refunds for the money already collected. Instead, they sent the case back down to a lower court. This means if these companies want their refunds, they'll have to start the whole legal battle over from scratch. Going through the district and appeals courts again. Well, that's easily going to take a few years. So, don't expect that $170 billion to flood the market and boost asset prices overnight. Even 10-year Treasury yields stayed flat on the news. It's a clear sign that savvy bond investors know that money isn't hitting the system quite yet. What we really need to watch is how countries that played ball with the Trump administration will act now that this ruling's been overturned. Alright, let's move on to our third and most important point. Back in October, when everyone was panicking about a crash, what were the big institutions actually doing? Well, the latest 13F filings just came out, and they reveal something really interesting. JP Morgan, the biggest bank in the US, added 2 million Bitcoin ETF shares last quarter. Goldman Sachs boosted their stake by 64%, and big players like Abu Dhabi's sovereign wealth fund are diving in too. See, they might issue reports warning about a market drop, but behind the scenes? They've been busy loading up on Bitcoin. Ethereum is even more impressive. Harvard University sold their Bitcoin to buy Ether, and BlackRock increased their stake by a staggering 165%. Isn't it ironic? While retail investors were panic selling, the Wall Street giants were actually opening their pockets even wider. Now, you might think, Ray, institutions can hold out because they're loaded, right? But they're actually much more rigorous about returns than we are. They don't just look at the price, they invest based on the market structure. These investors are looking at the long-term value, how Ethereum shapes the ecosystem and how Bitcoin finds its place in the mainstream. They don't sweat the daily price swings. They're just steadily building their portfolios exactly as they planned. Alright, let's wrap things up. We covered 3 big points today. First, those US economic numbers are just a bit wobbly from the shutdown and seasonal factors, so don't let it rattle you. Second, don't go betting it all on that rosy dream of Trump tariff refunds. And third, the big institutions are still buying steadily, so we really need to keep an eye on where they're heading and follow their lead. Listen everyone, investing isn't about today's price, it's about buying future value. Price is just a reflection of today, but the structure is what drives the future. While retail investors get shaken by price swings, the pros find conviction in the structure. Starting today, I don't want you stressing over those red and blue numbers jumping around on your screen. Instead, let's focus on the assets you believe in and take the time to learn how they're actually going to shape our future world. Small changes eventually create a massive difference in your net worth. Take a moment to check your portfolio right now. Ask yourself, am I holding on just because of the price, or do I truly believe in its future value? If you can simply let go of the urge to rush, you already have what it takes to be a top 1% investor. Make sure to subscribe and hit that like button. This is Ray, helping you grow your wealth today.